By the end of this video, you'll know exactly how to start your investing journey, including choosing the right index funds. Think of it like training for a marathon. Starting small and staying consistent is key to reaching your goals. We'll cover how much money you really need. Hint, it's surprisingly accessible. I'll also reveal why many beginners mistakenly prioritize saving over investing, how to determine if you're truly ready, and the specific strategy I recommend for turning modest, regular contributions into significant wealth over time. Let's get you prepared for financial success and avoid common pitfalls. Okay, so we've all been told that saving money is super important, right? Tuck some away in a savings account, watch it grow slowly, be responsible. It feels like the safe, smart thing to do, the first step towards feeling secure with your finances. You put your hard-earned cash in the bank and it's there, safe and sound. But what if I told you that just leaving your money sitting there means it's actually losing value? Every single day, something invisible is eating away at your savings. That hidden thief is inflation. Simply put, inflation means prices for everyday things, groceries, gas, rent, tend to rise over time. Think about what $20 bought 10 years ago versus today. The bill is the same, but its buying power has shrunk. Inflation ensures the same money buys less as time passes. So, while your savings account balance might look stable or grow slightly, its actual value is decreasing. That feeling of safety is misleading when inflation constantly works against you. This leads to a crucial realization. Saving alone isn't enough to build wealth or even maintain your standard of living. Relying only on saving is like paddling a leaky boat upstream against a strong current. You're working hard just to stay afloat, maybe even drifting backward as the water level, cost of living, rises around you. If your money isn't growing faster than prices, you're effectively getting poorer. Let's look at the numbers. Historically, average savings account interest rates hover below 1%, often much lower. Compare that to inflation, which has historically averaged around 2 to 3% annually in the US, sometimes spiking higher. The problem is clear: typical savings growth doesn't keep pace with rising prices, meaning your money loses purchasing power year after year. Now consider the stock market, often represented by the S&P 500 index. Over the long run, it has historically delivered average annual returns around 10%. While the market fluctuates short-term, its long-term performance has significantly outpaced both savings, interest, and inflation. This difference highlights opportunity cost. It's about the significant potential growth you miss by keeping money in low-yield savings instead of letting it work harder in the market. That gap between earning less than 1% versus a potential average of 10%, compounded over decades, represents the difference between losing value and building real wealth. I know some might think, but investing sounds risky. What if I lose money? That's valid. Saving feels safer because the dollar amount is stable. Investing involves risk. Values can drop, but let's reframe this. Investing, especially through diversified methods, isn't gambling. It's becoming a part owner of established businesses aiming to grow. You're buying tiny pieces of hundreds of companies, participating in their potential success. So why invest instead of just saving? History shows that over the long term, the potential rewards of investing significantly outweigh the guaranteed loss of purchasing power from saving. Saving protects your principal dollars short term, but inflation erodes their value. Investing, despite short-term volatility, offers the potential to grow your money much faster than inflation, enabling wealth building that saving alone cannot achieve. It's about growing your purchasing power, not just preserving dollars. So if saving isn't the answer, what's the smart way for a beginner to actually start growing their money? Let's look at the exact tool I'd use. Forget about spending hours researching which individual company might be the next big winner. What if you could basically own a small slice of hundreds of the most successful companies out there, all in one simple step? That's exactly the power we're going to unlock right now. Investing can seem overwhelming with stocks, crypto, options, and bonds feeling like a huge store with no map. This confusion makes many hesitate, but there's a simple tool: index funds, often available as ETFs, exchange-traded funds. Think of an index fund like ordering a sampler platter. Instead of picking one dish, you get a taste of many popular items. An index fund holds tiny pieces of many stocks, automatically chosen to match a market index, like the S&P 500. This index represents 500 large US companies: Apple, Microsoft, Amazon, etc. Buying an S&P 500 index fund instantly makes you a part owner of all 500. Trying to guess which single company's stock will soar is difficult. Even professional money managers struggle to consistently beat the market average. Instead of navigating that maze, index funds offer a clear path. Research confirms this. Source 1397685 notes that broadly diversified index funds, such as those that track the S&P 500, have largely outperformed actively managed funds that are trying to beat the market. This is significant because it shows even experts often can't beat simply owning the whole market, reducing pressure on you. The biggest advantage is instant diversification, spreading your money across hundreds of companies. If a few perform poorly, it doesn't sink your investment, reducing risk compared to owning few stocks. Another huge plus is low cost via small annual fees called expense ratios. Look for funds below 0.5%. Many top S&P 500 ETFs are much lower. VO and IVV charge just 0.03%, $3 per $10,000 invested annually. SPY is 0.095%. Fidelity's FNILX has a 0% expense ratio, no S&P licensing fees. These low costs, subtly deducted from returns, mean more money works for you. Unlike pressure active funds, index funds come as ETFs or mutual funds. ETFs trade like stocks during market hours, offering flexibility. Mutual funds trade once daily after close. For long-term investing, either works. ETFs are often slightly easier. Index fund investing is passive. You're not timing the market or picking stocks. You're participating in the economy's overall growth. History shows this broad market tends to rise long-term, so index funds are ideal for beginners. Instant diversification lowers risk, minimal costs maximize returns, and they're simple. Investing consistently in broad market index funds, tracking the S&P 500 like VOO, IVV, SPY, or FNILX is a proven, low-stress way to build wealth. Okay, you know why to invest and what to invest in these simple, powerful index funds. But the big questions remain. When should you actually start putting money in, and how much money do you actually need? Is your debt maybe making you feel stuck? Do you think you need thousands of dollars just to get started investing? And how do you actually go through the steps of buying your first investment without feeling totally lost? Let's clear up these common hurdles right now. First, let's tackle debt. Should you pay it all off before investing? Focus on high-interest debt first. Credit cards or loans above roughly 7% to 12%. Paying off a 20% interest card is like getting a guaranteed 20% return, something the market rarely offers risk-free. This is often your smartest initial move. Lower interest debt like mortgages or federal student loans might be okay to pay slowly while you start investing. As market returns, averaging 10% long-term could potentially outpace those rates. Conquering high-interest debt is your first major obstacle overcome on this journey. Before investing though, build an emergency fund, 3 to 6 months of essential living expenses in an easily accessible savings account. Why? Imagine your car suddenly needs a $2,000 repair, or a medical bill arrives unexpectedly. Without that cash cushion, you might be forced to sell your investments at a loss, perhaps during a market downturn, just to cover the cost, or worse, go into high-interest debt. This fund is your shield against life's unexpected ambushes, protecting your long-term investment plan. Build this safety net first. With debt managed and your shield ready, how much money do you need? Forget needing thousands. Thanks to fractional shares, you can start with $5, $20, or $100. Whatever fits your budget. You buy a dollar amount of an ETF, not a full share, making it accessible. Yes, investing $50,000 yields more profit than $10 at the same return rate, but the crucial step is to start with money you won't need for at least a few years. You've discovered the entry fee isn't a fortune, just the willingness to begin. So, how do you actually buy? 1. Open a brokerage account with a reputable firm like Fidelity, Charles Schwab, or Vanguard. This is usually a straightforward online process. 2. Link your bank account and transfer the cash you want to invest. 3. Log into your brokerage account and find the trade option. Enter the ETF ticker symbol, e.g. VOO. 5. Select Buy. Choose Market Order for simplicity, buys at the current price. 6. Crucially, enter the dollar amount you wish to invest, e.g. 50, not the number of shares. 7. Review the order and click Place Order. You've now forged your first investment. Finally, embrace the right mindset. Investing builds wealth steadily over time, not overnight. Plan to hold investments for the long haul, 3 to 5 years minimum. ideally much longer. Market charts show scary dips. These are normal. Panicking and selling during downturns locks in losses. Avoid this. Historically, markets recover and trend upwards. Patience is key. Stay invested, add consistently if possible, and trust the process. It's time in the market, not timing the market. This final trial tests your resolve. Patience. Getting to financial independence isn't about complicated charts. It truly begins with one simple action, repeated consistently. Regularly investing in simple, low-cost index funds is the proven way to build serious wealth over time through compounding. But you must stay invested through the ups and downs to capture that growth. Don't miss out by trying to guess the market's moves. So, what's your first step today? Will you tackle debt, start that emergency fund, or open a brokerage account? Imagine what you will achieve when you start building your financial future now.